Welcome back, folks. It's another great day here on Valiant Renegade. Make sure you hit that like, hit that subscribe, hit that notification bell. Share this sucker out on the social medias. And do leave a comment before you head out today. Because this is where Hollywood comes to get put through the business and financial lens of reality. It's time. Renegade Online. Good afternoon, ladies and gentlemen, and welcome back to a very special edition of Renegade Online. Today, we are covering the Q1 earnings call for Netflix. Yeah, big old Netflix, the leader in the streaming space, one of the Magnificent Seven out there. And, we love covering the Hollywood and entertainment industry. And one of the best earnings calls to cover when we can is Netflix. They're always very positive. They're always very upbeat. And they always have a tremendous amount of good news to report. Today is not going to be any different. The earnings came out about 10 or 15 minutes ago, and we're going to cover them here, the actual earnings interview. And I love the way Netflix does this. They cover this. They do a live broadcast on YouTube, and we're going to be restreaming that like we always do. Netflix tends to do these earlier in the day, so it's a little bit harder for me to get to do these as frequently as I like, but I really make it a point to go in and try to get to these, and today it kind of happened to work out. Let's take a look in at after hours right now with Netflix. Again, we don't do financial advice here on Valiant Renegade, but we do cover the Hollywood and entertainment industry, like I said, and we always cover the business side of it. So we'd be remiss if we didn't look at this stuff. Netflix it's had a great run. I mean, it's up 4.31% right now, and after hours, it's back over $1,000 a share. And to kind of give you an idea here, we know we've had a lot of volatility in the year so far in 2025. I want you to take a look. This is let me go to year to date. We can see right here when we got down into the doldrums, April 4th, the really ugly day, the second really ugly day, Netflix pitched all the way down to about $850 a share off of a high of about $1,064. So it was down in the vicinity, getting close to 20%, right just under 20%. But if you look right now, Netflix has basically bounced back. It's recovered everything since the market has gone down. The same cannot be said for most other companies, especially in the NASDAQ 100. And part of this is Wall Street's, and I think correct thinking that Netflix, regardless of what may happen with any of the tariffs that may or may not ever really come to fruition. I know the fear right now is everything Trump is throwing out is going to be really bad and it's going to be permanent, yada, yada, yada. We've been saying for a long time that's not what Trump is really after. What he's after is a new set of trading deals with all of these foreign countries. Well, whatever may come out of that is for another discussion. But when it comes to this discussion, one of the things that's been helping Netflix is the view that Netflix is relatively insulated from any of this. They're not importing products. Sure, they may hire a lot of productions or create a lot of productions from overseas or something like this. They might film in Vancouver. And again, they hire out third-party studios to do the vast majority of their work. It's not like an internal Netflix team that's making all of these shows that you see on Netflix. This is a very different animal. And Netflix has something that other companies out there, other streamers, especially guys like the Walt Disney Company that we cover quite a bit of, wish they had, could only dream that they have. And that is a massive profit margin on streaming. And that is massive amounts of engagement on their streaming service. I mean, we talk about it all the time. When you look at the average show on, say, Disney Plus, and you consider what Disney spends to create content for Disney Plus every year and what Netflix spends on content every year, I mean, Disney Plus, for any given show, Star Wars, Marvel, it doesn't matter, spend $200 or $300 million on a show. And those Disney Plus shows are bringing in somewhere to the tune of, on average, maybe 1/5 or 1/10 of what the average piece of whatever on Netflix will get on any given Friday that's brand new. That's the big difference. Netflix is also opening up more advertising revenue. Their advertising-based tier, since they introduced it a little over a year ago, is taken off like a bat out of hell. No surprise. Why do you think that is? Because advertisers want to go where viewers are, and viewers are on. If they're not watching YouTube, how you doing? And welcome aboard to the Renegade Nation. Please do smash that like and subscribe button. But if they're not watching things on YouTube, they're watching stuff on Netflix. And we've got the earnings report here. The interview will begin in about 10 minutes. Don't worry. You haven't missed anything. We will be joining the interview as soon as it pops up. Matter of fact, I'll show you. It's right here. It's still on a countdown clock. See, 9 minutes and 14 seconds left to go. So we have time to discuss some things. So let's take a look here. We've got the financial earnings. They're out. You can go get these yourself on the Netflix page. And let's take a look at some of the data and see what everybody is so excited about with Netflix. We're off to a good start in 2025. In Q1, which was January 1st through March 31st of this year, this is the quarter that we're reporting today with Netflix. The revenue and operating income, for those of you who are new here, is a measurement of profitability. Gross revenues, top-line revenues grew by 13%. OI, or operating income, grew by 27% year over year, respectively. That's a big freaking number. Anytime you can have growth, double-digit growth consistently quarter over quarter, year over year, hey, I mean, this is phenomenal. And Netflix continues to pound away at this. Both of these were ahead of our guidance due to slightly higher subscriptions and ad revenue and the timing of expenses. And then they talk about some of the new things coming in, some of the big hits. They talk about WWE Raw, which is a live service sport they've added to it. Of course, they've got more stuff coming. Netflix is trying to dive more into live events, live sports in particular, and talking a little bit about some of the stuff that they've got coming out, more boxing matches, things of this nature. Revenue and profit growth outlook, and this is forward guidance, so nothing guaranteed here, remains solid. We're not changing any of our 2025 forecasts on guidance for revenue. We're looking at $43 to 40 or $43.5 to $44.5 billion of gross revenue or sales. Operating margin of 29%. Count it, 29%. And this is what I really want to talk about here. I've been telling you for some time that Netflix was just around the corner of overtaking the Walt Disney Company's entire enterprise when it comes to dollar profit. And it looks like it might actually happen in 2025. Last year, 2024, for the whole year, Netflix had about $39 billion or so in gross revenues, had about a 26% profit margin, I believe, if memory serves. Came in with about a $10.5 billion operating income. It's looking like this year, their operating income is going to be over $12 billion. The Walt Disney Company's operating income for their fiscal 2024 was about $12.5 billion, or right around $12 billion, if memory serves. So Netflix, with less than half of the gross revenues, with no theme parks, no hotels, no cruise ships, no ESPN, no 3 different streaming services. It's all just Netflix, right? No massive $300 million cinematic productions, no contracts for Marvel, doesn't own Star Wars, doesn't have a distribution contract with James Cameron's Avatar, right? None of this kind of stuff. All it has is a little old streaming service. They're going to make more money this year than Disney. That's where we are. That's what it's looking like, short of Disney turning things around and offering some big surprises. But we already know the Walt Disney Company is in the toilet right now, and things aren't going to get any better this summer. When they already were expecting softening theme parks in terms of attendance, and things aren't going to get any better for them when Epic Universe opens in about a month. And even Wall Street seemed to acknowledging that Disney has some issues going on. But this is my point. Look at what Netflix is doing with just streaming by producing content for people that want it and enjoy the content they're getting. And most importantly, and this is the thing, Netflix has continued to increase their pricing structure, right? They're going up $1 or $2 every single year for every tier that they've got, save for the ad-based tier. Single user ad-based tier, I think, is still $6.99 a month, which when you consider the library that you get, that's a hell of a deal. And here's the thing, the proof's in the pudding. With over 300 million subscribers under their belt, or what they refer to as members, Netflix has absolutely killed the price to value model. They can keep raising prices. They apparently have a hell of a lot of elasticity. You know, I'm paying the top tier. I've got the 4 television 4K thing. I'm paying $22 a month or whatever it is for Netflix. But I've got a family. I've got a wife. I've got 3 children. So we use it. We use the hell out of it. But the value of what you get there apparently is working for Netflix. And that's one of the things that they have figured out how to do, is truly put value into what they're billing. And I think Disney's on the opposite side of the panel in terms of what they're charging right now. For example, for Disney Plus, Hulu, they can get away with it on. But as the pricing models for Disney Plus keep going up, short of kids getting disinterested in Bluey, parents are going to still be hanging on to Disney Plus for that. But when it comes to their other $1 billion+ a year in content spend for Star Wars and Marvel, it's obviously not working for them nearly as much as they need it to be. When you look at numbers like this from Netflix and you consider the fact, just to put a real pin in this, okay, look at the market capitalization right now, $416 billion in market cap for Netflix. That's what Wall Street, based on the stock price, says that Netflix is worth in total, $416 billion. That's nearly 3 times now what the Walt Disney Company is worth, and that doesn't even include this aftermarket 5% boost. So add another 20 some odd million dollars to that figure. We're at about $436 billion. So right at about 3 times what Wall Street thinks the Walt Disney Company is worth. And again, just with streaming, no theme parks, no hotels, no cruise ships, no $100 billion property. Didn't spend $72 billion to buy the Fox studio library at Netflix. Didn't spend $4 billion to buy Marvel. Didn't spend $4 billion to buy Star Wars. Didn't spend billions more to buy Pixar and everything else. This is what Netflix is doing in its own little ecosystem, and it's working for them. It's working great. All right, we've got about let's see, we've got just a couple of minutes here. It should be starting any moment. So let me see. I think we have a couple of super chats here. We've got to get started. Butter Biscuit says, "Valiant, good to see you." Paul Farrell says, "Happy to be catching a live stream. Thank you for being a member for 14 months. Mexican Iron Man, jump in, Mike, if you like, for $5. The Mexican Super Chat police standing by from remote location at Hilton Head. Go-kart Indy team with Mexican." Well, Mike, you have the secret key to get in backstage. So if you can make it, cool. William Thompson says, "For 2, I'm available for the panel." I appreciate it, man. On these earnings calls, we tend to fly light on these suckers, but we'll do another member stream here pretty soon. All right, let me switch this out so we can get the audio pulled up. Bear with me 1 second. And we're going to get into this here. I think we've covered all the high points, and then we're going to let the boys over there at Netflix tell us what else is going on. Here we go. Stop screen, reshare screen. There we go. Okay. We should be starting here any moment. Let me just make sure I refresh this. Okie doke. Yeah, it is live. We're just waiting on the countdown now. Let me get the headphones in, and we'll be off and rolling. Hopefully we don't have any really copyright nasty music that's going to be playing and destroy me. No copyright music. Okay. There is no audio as of right now, so don't worry. You're not missing anything. We're less than a minute away, so we should be starting very, very soon. All right. Appreciate everybody joining us out there. Many thanks to you all. We will, of course, be having our regular Sunday show. However, as I mentioned before, it may be shorter. Of course, it's Easter Sunday. It may happen a little bit later in the day. Just depends on family schedule for that afternoon. We may push it back to around 6. We'll see. This is the time of year we get a lot of these Sunday holidays that come up. We got Mother's Day, Father's Day, Easter Sunday. It just goes on and on and on. Of course, it always plays hell with the regular schedule, but we do what we can. All right, so they're running a little slow right now. So let's see who's out there in the chat, who's making it in here. Josh Hammond, first up. Thank you, Josh. See you out there. What's up, Ghost Fixer? We've got Brandon Day, hail from the 199, and hail to the 199 and the Snake Pit and all the other great guys out there. Hi ho, here from Yiddish. Good to see you guys. The mum is here. Miss Kitty is here. Thank you for being here. Let's see. Yek Nomino. Hopefully I got that right. Yek Nomino. Fallen Angel is here. Looks like we're about to get started. I just saw the screen kind of flicker here. All right, Netflix, get off and rolling. Here we are.
Sorry, Lily, should we?
They weren't quite ready.
Good afternoon, and welcome to the Netflix Q1 2025 earnings interview. I'm Spencer Wong, VP of Finance, IR, and Corporate Development. Joining me today are co-CEOs Ted Sarandos and Greg Peters, and CFO Spence Neumann. As a reminder, we will be making forward-looking statements, and actual results may vary. We'll now take questions from the analyst community, and we will begin first with our results, outlook, and forecast. And our first question comes from Robert Fishman of MoffettNathanson. Robert's question is, the Wall Street Journal report this week discussed Netflix's internal goal of doubling revenue and tripling operating income by 2030. How should investors think about Netflix leaning into more content spending over the next 5 years?
I'll take this, and thanks, Robert. Look, we have a unique culture.
Ted Sarandos,
and part
Netflix
of it is
CEO.
this open information operating style, and it has served us very, very well. On rare and very disappointing occasions, our confidential and internal discussions can leak into the press. And while we wouldn't normally comment about leaked internal information, we do want to be extra clear about this. We often have internal meetings and we talk about long-term aspirations, but it's important to note that this is not the same as forecast. Our operating plans is the same as our external forecasting guidance. We don't have a 5-year forecast or 5-year guidance, but you can assume that we're long-range thinking and that we're working hard every day to build the most loved and valued entertainment company for all of our stakeholders.
And maybe to pivot the conversation to what we're happy to comment on and discuss in detail. We do have big long-term aspirations, and those aspirations are really grounded in the potential for growth that we see in the business. Now, we think we got a pretty good business today, over 40 billion in revenue. We've got over 300 million paid households. Those represent an audience of over 700 million individuals. We're leading in streaming view share, but we also think that we're a minority of our addressable market, our potential across any of those measures. So you think about engagement, we're less than 10% of TV hours. From an audience or a connected households perspective, we still got hundreds of millions of folks to sign up. And from a revenue perspective, we're about 6% of consumer spend and ad revenue in the countries we serve, in the areas that we serve. So we believe we got plenty of room to grow our engagement, our revenue, and our profit. And as Ted said, do that to become the most valued and loved entertainment company for all of our stakeholders.
Thanks, Ted and Greg. Our next question, or I should say we have received several questions, actually, understandably, about the economic environment and consumer sentiment as well. For example, Jason Helfstein from Oppenheimer asks, this is the first time you are potentially entering a recession with a low-cost ad plan. How do you think about consumers downgrading plans relative to the behavior you've seen in prior recessions?
Yeah, given that we've got a bunch of questions on sort of the general economic environment, maybe just start with some comments on that. We're paying close attention clearly to the consumer sentiment and where the broader economy is moving. But based on what we are seeing by actually operating the business right now, there's nothing really significant to note. So what are we looking at? Primary metrics and indicators would be our retention, that's stable and strong. We haven't seen any significant changes in plan mix or plan take rate to part of that question. Our most recent price changes have been in line with expectations. Engagement remains strong and healthy. So things generally look stable from that lens. Stepping back, we also take some comfort in the fact that entertainment historically has been pretty resilient in tougher economic times. Netflix specifically also has been generally quite resilient, and we haven't seen any major impacts during those tougher times, albeit, of course, over a much shorter history. And then to the point of the specific question, I think that having the low cost ads plan in our largest markets also gives us more resilience. And we think that we represent an incredible entertainment value, starting at $7.99 in the US and Canada with that ads plan. It's an accessible price point, and we really do expect the demand for entertainment to remain strong.
Yeah, and just to add to that, Greg, a bit, we remain focused on the things that we can control, and improving the value of Netflix is the big one. Historically, in tougher economies, home entertainment value is really important to consumer households, and Netflix is a tremendous value in absolute terms and certainly in competitive terms. So there are some international risks that folks talk about, what's happening now, and I'd say, look, there always has been. We pay taxes and levies around the world, consistent with all sorts of local regulations, and so there's always some of that has existed, always has. But what we're seeing today, we're not changing anything in the forecast. So kind of keep in mind that while the U.S. represents our largest spend for content and employees, production infrastructure, we produce original content in 50 countries around the world. And we're a net contributor to many of those economies and cultures. So in our letter, we talked about our commitment to the UK. We also recently announced $1 billion commitment to production in Mexico. In 2023, we announced we were $2.5 billion and committed to Korean content in Korea. And all of these are just examples of the global commitment. So when we produce in these countries, we create and support employment and training. We work with local producers and local talent. We help export local stories and local cultures around the world. And we even drive tourism. So we believe we're additive to the local economies and the local cultures all around the world where we're working. So perhaps a little bit less exposed.
Thanks, Ted. So that sort of takes care of the question we got from Dan Salmon specifically on tariffs as well. So I'll move us along to a question now from Rich Greenfield of Lightshed Partners. Does your price increase cadence change due to the global economic uncertainty, or is that outweighed by the strength of your slate and increased time spent watching Netflix?
Yeah, it really links to how we think about price changes. As we stated before, we really rely on our members to let us know when we've invested enough, grown the value in our offering, and then determine based on that when we adjust pricing to be able to reinvest back into our service. So we're going to continue to follow that philosophy and that path rather than some predetermined plan. We certainly seen periods of challenging economic conditions historically in different countries, and we've generally been able to keep that positive flywheel spinning even in those situations. And I think that speaks to the gap between value and price, and that we are, for many people, a very good value, even as they're being careful about where they spend. We've also been expanding that range of price points, including the low-priced ads plan in our ads market, which better allows us to offer the right plan at the right price to a wider range of consumers. So that's all to say that we're proceeding largely as we've done in the past, while continuing to work to improve both value and accessibility.
Great. Thanks, Greg. Our next question is from John Hoodlick of UBS. How has member retention been trending given the Q4 strong paid net additions? Have you retained the bulk of these subscribers, and can you give us a sense of how churn has been trending?
Yeah, sure. Spencer, why don't I take that one? Give Greg and Ted a break for a sec. As Greg mentioned, we're seeing strong, stable acquisition and retention trends in the business generally. That resulted in healthy member growth in Q1. Last quarter we did provide some color on the retention characteristics for some of those bigger live events in Q4. Recall we had the Paul Tyson fight, we had NFL on Christmas Day, and we also had Squid Game, which was an event in and of itself. So, but we did mention at the time that those three big events were still a small minority of our net adds in Q4. But we also noted that the retention characteristics for the members that came in for those big events was similar to members that joined for other big titles, and that continues to be the case. So, really no meaningful changes to our retention story, which, no news on that front is good news from our perspective.
Thanks, Spence. We have another question about our outlook and forecast from Michael Morris of Guggenheim. Given the strength in operating margins in the first half of the year, can you discuss the key incremental costs that will drive lower margins in the second half? Do you expect these costs to be more heavily weighted to the third quarter or the fourth quarter? Spence?
Yeah, I'll take it again. Okay, thanks, Michael. So, like we, as you see in our letter, and as you mentioned, we're still forecasting 29% full year operating margin for the year. And we primarily manage the full year margin. As you know, our margins bounce around a bit quarter to quarter. That's usually based on the timing of our content slate. That's the primary driver, and that's what's reflected in our forecast. So, content expense we expect it'll grow and ramp in Q3 and Q4 on a year-over-year basis, given the timing of our slate. We've got our biggest titles returning in the back half of the year. I'm sure Ted will talk to some of that later in the call. And also, typically in Q4, we have a heavier film slate. We've also got sales and marketing expenses that we expect would ramp in the second half of the year, both to support the slate, but also ad sales. This go-to-market operations and our hitting and our marketing and sales align, so that we're continuing to build out our sales operations and capabilities, and some of that is hitting there and growing in the back half. So all of that is expected and reflected in our guidance. Other than, as I said, a little bit of a heavier slate, typically on the film side in Q4, no meaningful differences between Q3 and Q4. The one thing maybe I'll also just add, Spencer, is we obviously beat a bit in operating income in Q1, but at this point, most of that was there's a little bit on the revenue side, mostly on the expense side, and it looks to us that most of that was timing of spend. But still spend that we would expect to hit in the full year. So there's still a long ways to go in the year, a good bit of macro uncertainty out there. So this is still our best estimate for kind of outlook for the year.
Thanks, Spence. I'll move us along now to a set of questions around advertising.
Damn near 30% profit margin. I mean, an operating income was what they expect for the year. That's crazy.
To the television upfronts, any broad thoughts on how you're approaching upfront versus the scatter market would be great.
Sure. Similar to commentary on the consumer sentiment, we're keeping a close eye on the marketplace, but we aren't currently seeing any signs of softness from our direct interactions with buyers. Actually, to the opposite, we're seeing some positive indicators from clients as we approach our upfront event. I think worth noting perhaps that the fact that we're currently relatively small in ads, and that's sort of, ads as a revenue contributor to Netflix, but probably more importantly, the amount of ad spend that we're seeking to win relative to the big ads pie, that smallness probably provides us some insulation to market shifts right now. And we are, rolling out our proprietary ad tech suite. We've rolled that out in Canada, United States. We've got our remaining 10 markets coming. That offers a bunch of new capabilities that advertisers have told us they want. So we're just starting to sell into those new capabilities. That opens up new opportunities for us. It opens up new demand for us as well. So I would say, based on everything that we're seeing right now, we continue to expect that we will roughly double our advertising revenue in 2025 through a combination of both upfronts, programmatic expansion, and scatter.
Thanks, Greg. And that's a very good segue to our next question, which comes from Vikram of Baird. Could you provide an update on your first-party ad tech platform? How's the rollout in Canada performed relative to your expectations? And do you have any observations so far in the US?
Yeah, it's a big milestone for us to roll out our own ad suite. We've been working on it for a while. We're still in the middle of that rollout, but our Canada and US launches have gone well. They're consistent with our expectations. We're learning and improving quickly now based on the feedback we're getting from having those live and operating them. Then we'll roll out across the remaining 10 ads markets in a few stages over the coming months. So that's sort of all lined up and ready to go. The biggest initial benefit that we are seeing, again, as expected from being on our own ad server, is it just enables more flexibility for advertisers, more ways that they can buy. There's fewer activation hurdles. We have the ability to improve that overall buyer experience iteratively. It just makes it easier to transact with Netflix. And that, of course, drives increased sales. And so we're seeing that. And then we expect over time that our first-party ad tech platform will allow us to do other things, deliver more critical capabilities more quickly to advertisers. These are things like more programmatic availability, something we definitely hear demand for, enhanced targeting, something we're excited about. We can leverage more data sources, and of course, something we hear all the time, more measurement and reporting capabilities. So those are all things that we've got in work. Some of those have been delivered already in some of the territories, and those will come over time. And then the other big space of benefit by being on our own ads tech stack is it enables us to have more control to create a higher quality ad experience for our members. This is, things that are really important, like increasing ad relevance, which is just it's good for everybody in the whole ecosystem. So just getting started, excited to get it out there. We got many years of building ahead of us, but we've got a clear roadmap. We know what we're committed to, and we'll just continually to iteratively improve and innovate in advertising, just like you've seen us do in all sorts of other areas.
Thanks, Greg. And speaking of ads relevance, Justin Patterson has a longer-term question on ads. Netflix has solved personalized content recommendations. What are the key steps to solving ad content recommendations or relevance? And which inning do you believe you're in?
Not sure I would characterize as completely solved. We hope that we can be even better day to day in recommending the main titles. But we do have an ambition to achieve that same level of sophistication and maturity capability that we did on the personalized recommendations in the ad space. So that means matching the right ad with the right audience, the right viewer, and the right title. And we think putting those three things together drives superior campaign outcomes for advertisers. And we think it's a better experience for members. So it's win-win-win. Where are we at in that process? I would say that we are literally just beginning to get that going. So the first stage of that is actually being on our own ads platform. We've launched that, as I said, in Canada, US. We've got the remaining markets coming over the next months to come. And in doing that, during this time, we've been able to significantly already expand our targeting capabilities. So that now includes targeting features that are based on Netflix unique data. So think life stage, interest, viewing mood. In the US, we've also recently enabled advertisers to do more significant targeting. So this is targeting on their own onboarded audiences, targeting on Netflix modeled audiences, targeting against audience segments that are provided by a select set of third-party vendors. So we've got a lot of exciting work going on in that space. And then looking ahead, in 2026, we'll do more of that, more data targeting capabilities. We'll move more of that globally. So a lot of things we do, we start in the United States and expand across more territories. You'll see that. And then, of course, more measurement functionality in all markets. And then in 2027, we get to look to specific focused investments at a higher order in data capabilities such as ML-based optimizations. We've got advanced measurement, advanced targeting. We'll be really opening a rich space there. Another big benefit we get on our own ad stack is we'll be able to innovate and develop more quickly new ad formats. So we have more spaces that we can, point all of that improved targeting capability against. So just getting started in the space, we got a lot of work to do for sure, but we think we'll be able to move very quickly, and frankly more quickly than other streamers, because we believe we're going to be able to leverage not only pre-existing tech that we have, data that we have, but also data science expertise and the rapid product innovation experience that we've got.
And I guess, Greg, the inning analogy gives us a little more flexibility than crawl, walk, run, right? So when you walk through all that, it's nice to have all those innings ahead of us.
Yeah.
9 options instead of 3.
That's right. Stepping up to the plate, starting to swing. That'd be where we're at.
Yeah. Thanks, Greg. I'll move us along to a series of content-related questions from analysts, beginning with Rich Greenfield from Lightshed. There are 4 major sports properties available right now. How should we think about the strategic fit for Netflix in terms of number 1, the UFC, number 2, WWE Premium Live Events, number 3, F1, and number 4, Major League Baseball?
Thanks, Rich. I do want to remind you that our live strategy is beyond just sports. So I'm not going to comment on any of those specific opportunities at this time. But I will steer you back to the letter to show you that our live event strategy is unchanged, and we remain really focused on the big breakthrough events. Our audiences love them, and so anything we chase in the event space or the sports space is a deal that have to make economic sense as well. So live is a relatively small part of our content spend. We have about 200 billion view hours, so small relative to view hours too. But that being said, all viewing is not equal. What we have seen with live is this very outsized positives around conversation and acquisition, and we suspect retention. And we're really excited to keep building on that. We have the Taylor Serrano fight in July. That's a rematch from when they fought the first time on the Tyson Paul fight night. It was the most watched women's sporting event in U.S. history. So there's a lot of excitement around that. The NFL, of course, is a great property, and we're happy to have the Christmas Day games. So we opted into the second NFL game for Christmas Day. So we'll be presenting all day football again on December 25th, 2025. Really exciting. And then today, our live adventures have all been primarily in the US, but we intend to grow the capability to do it around the world in the years ahead. So very pleased with the progress so far and excited about the future for live sports and non-sports.
Thanks, Ted. The next question is from Matt Thornton of FBN Securities. Do you think video podcasts could perform well as a category on Netflix?
So we're constantly looking at all different types of content and content creators. The lines between podcast and talk shows are getting pretty blurry. We want to work with kind of great creators across all kinds of media that consumers love. And podcasts, to your point, have become a lot more video forward. And today we actually produce a lot of podcasts ourselves as part of our kind of publicity and publishing efforts. So some are really show specific, like Squid Game and Diplomat. Some are genre focused, some are talent focused. We have a great one called You Can't Make This Up, all about Netflix docs. And they live everywhere podcasts live today. But as the popularity of video podcasts grow, I suspect you'll see some of them find their way to Netflix.
Thanks, Ted. From Rich Greenfield again, how do you create iconic animated franchises? What does it really take to build out culturally relevant animated IP? Is the answer a different team, acquisitions, or something else entirely?
Do the opposite of Disney.
Well, thanks, Rich. Keep in mind, this we're relatively new at this, and it's a completely creative process. We've had some hits, and we've also had some misses, so we know we have work to do. But I would point out that we've had some really nice hits with Leo, with Sea Beast, Guillermo del Toro's Pinocchio, certainly pierced culture, even won the Oscar for us for Best Animated Feature Film. And the other thing we keep in mind about why we're excited about this space, there's a lot of demand for animated film. In 2024, 9 out of the top 10 most streamed movies were animated features. So just like in our live action strategy, we want to make some, we want to license some. And we have more access today to license than we did when we began in-house animation. And we get to that now through output deals with Universal, Illumination, and Sony.
I was about to say Universal.
But the animation team, Hannah and Dan, they're working really hard on a very promising slate of exclusive originals they're going to roll out through 2027, including one called In Your Dreams coming out in Q4, which is really fun, really entertaining, beautifully produced film that I think you're going to love. So we got our work cut out for us, but it's a big prize.
If they call,
Thanks,
I'll
Ted.
answer the phone.
Our next question comes from Robert Fishman of MoffettNathanson. As you think about the competitive landscape over the next 5 years, should investors expect Netflix to move into short form or creator-led content to compete head-to-head with YouTube?
Ooh,
Sure, I'll kick this one off.
I love
think
these questions.
Just starting at the macro lens, we've always had very strong competitors, including YouTube, many others. We're all definitely competing hard for people's entertainment time. So we absolutely have to earn every hour that we win. We don't take anything for granted. We don't get anything for free. We wake up every day eager to improve our service for our members and for members to be. We also think in that broadest competitive lens that the biggest opportunity we've got is actually going after the roughly 80% share of TV time that neither Netflix nor YouTube have today. We think of that as a real immediate opportunity. And then when it comes to the specific head-to-head competition with YouTube or other platforms like YouTube, we believe we are a more competitive, better service for a certain class of creators and certain types of storytelling. And most importantly in that is that we lead monetization for those kinds of titles. And that means we can provide a better opportunity than YouTube or other services for those creators and those stories. And Ted, maybe you want to comment on the creator and content type expansion.
Yeah, sure. We're looking for the next generation of great creators, and we're looking everywhere. So they're not just in film schools, and certainly not just in Hollywood. Creators today have tools that were unimaginable a decade ago, to tell stories, to reach audience. The question is out there is it premium? Well, some of it is. And we believe we have the best monetization model on the planet for premium storytelling. I think we can help those creators reach an audience. Our model can also support more ambitious efforts for them, can help de-risk them, unlike the kind of typical UGC models. Look at folks like Miss Rachel. She's been in the top 10 every week since she launched on Netflix. Kill Tony right now is killing it with our stand-up fans. We're working with Sidemen. We just launched Pop the Balloon. So we think it's really exciting. When you put this all together, we believe it's the best place for premium content as defined by fans, and the best home for storytellers wherever they're working on honing their skills today.
Thank you. From Ben Swinburne of Morgan Stanley, we are starting to
Swinburne.
see some of the fear around AI and content creation subside, and major directors like the Russos, Jim Cameron, etc., begin embracing the technology. What is Netflix doing to leverage AI for its creative partners? How meaningful can this be? And are there any examples that you can share?
Well, Ben, there's a ton of excitement about what AI can do for content creators. I read the article too, what Jim Cameron said about making movies 50% cheaper. I remain convinced that there's an even bigger opportunity if you can make movies 10% better. So our talent today is using AI tools to do set references for previs, VFX sequence prep, shot planning, all kinds of things today that got to make the process better. Traditionally, only big budget projects would have access to things like advanced visual effects such as de-aging. So today you can use these AI powered tools to enable smaller budget projects to have access to big VFX on screen. A recent example I think is really exciting. Rodrigo Prieto was the DP on The Irishman just 5 years ago. And if you remember that movie, we were using very cutting edge, very expensive de-aging technology that still had massive limitations, still created a bunch of complexity on set for the actors. It was a giant leap forward for sure, but nowhere near what we needed for that film. So this year, just 5 years later, Rodrigo's directing his first feature film for us, Pedro Paramore in Mexico. Using AI-powered tools, he was able to deliver this de-aging VFX to the screen, for a fraction of what it cost on The Irishman. In fact, the entire budget of the film was about the VFX cost on The Irishman. So same creator using new tools, better tools to do something that would have been impossible to do just 5 years ago. That's incredibly exciting. So our focus is simple: find ways for AI to improve the member and the creator experience.
Thanks, Ted. Our next question is from David Joyce of Seaport Research Partners. The question is, with so much content in your library, what can you do for discovery to help drive further engagement with the platform? Is there anything further structural you can do with the recommendation engine, or is it going to require more marketing?
Yeah, a fact that surprises many people is that even our most popular, most buzzy titles that you're hearing tons of conversation around, those still drive less than 1% of viewing. So that discovery and recommendations capabilities are really critical to unlocking all the value from the investments that Bella's team is making around the world. And we believe, and we continually see this in test results quarter after quarter, that there is more room to improve that discovery and recommendation experience, and therefore provide more value for members, and therefore find the biggest audiences for around the world for our titles. To that end, some examples of this: last year, we began testing a new, simpler, more intuitive TV homepage. This is something that we hadn't made big structural changes to in over a decade. And we believe that will significantly improve the discovery experience on Netflix. We've been polishing and improving that experience based on the input we got from members who used it. And we plan on rolling that out later this year. So that's very exciting and a pretty significant structural shift that we anticipate will move things forward significantly. But we're doing things at the other end of the spectrum too. So we're also building out like new capabilities. An example would be interactive search. that's based on generative technologies. We expect that will improve that aspect of discovery for members. So there's many specific improvements that we've got in works. So a lot more to come in the space, and really, frankly, no foreseeable limit on those improvements in the years to come.
Great. Thanks, Greg. Michael Morris from Guggenheim has our next question. It's actually about extra member accounts. How has adoption of extra member accounts trended since launch? Can you share how this offer has contributed to revenue growth to date, and whether you see it as additive to future growth?
We see extra member as a part of our plans and pricing model. So it's an option that provides flexibility and choice for members. It allows them to, tailor the Netflix offering to their needs. We know some members want to share Netflix with family or friends. An extra member gives them an easy way to do that. It's a lower cost way to do that as well. We see good retention and engagement on that plan, which is really important to us, and says it's a sort of healthy part of the offering. But while we love it from a member convenience perspective, responding directly to the question, extra member isn't a major driver for our business, and we expect it'll remain relatively small in the foreseeable future.
Thanks, Greg.
I just say to Greg's point, I agree with all that. It is, I think, part of the question. It is still growing modestly, but it's healthy for all those reasons, but it's just not a big driver of the business.
Thanks, Spencer, for clarifying. Justin Patterson from KeyBank with the next question. Alon, who leads our Netflix games business, spoke recently at the Games Developer Conference about making gaming more accessible and achieving mass market appeal. What types of games have resonated on Netflix so far, and where do you see opportunities to improve the user
Anything
experience
consulted on by
driving
Sweet
even more
Baby Inc.
engagement for games?
Yep, we have learned quite a bit, made some decent progress since we launched
Sorry.
games, but we continue to see this as a multi-year iterative journey, much like we've seen and you've seen from us when we launch a new content category or we launch a new country, and we develop product market fit and improve that over time. You asked what games have worked for us so far. You can see much of the answer to that question embedded in the genres that we're going after and focusing on right now. So that starts with immersive narrative games based on our IP. Squid Game Unleashed is a really good example. We'll have an update for that game with the latest season of Squid Game that's coming. More recently, Thronglets, which is our Black Mirror-based Tamagotchi-style game that
I wanted to check that one out.
Dark twist in the end, very consistent with Black Mirror. Another category that we're going after is mainstream established titles. This is Grand Theft Auto, which really worked for us, and you'll see us launch more titles like that in the future. There's also games for kids, being able to give kids a game experience that's free of ads, it's free of any in-app purchases, safe for parents with a subscription. We just announced Peppa Pig game, which is coming soon. So that's an example of that. And the fourth category, which I would say we don't have a lot of data points demonstrated in yet, but we're excited about and we'll be delivering some to understand the space better, is socially engaging party games. Think about this as, either an evolution of the family board game or an evolution of the game show on TV that becomes interactive in your living room. So lots of excitement there. And then you mentioned in terms of areas to improve. There's tons of areas to improve. Frankly, we can improve everything that we're doing, from user experience and discovery and getting to play, but also just in having more compelling games. So that's a real top priority for us at this point. And maybe just a few comments with regard to how we think about investment and growth in this space. We've always said that we were in this to win. We want to invest enough to ensure that we are playing to win, but we also are coming knowing that we've got a lot to learn, and we still have a lot to learn despite all that we've learned so far. We don't want to grow our investment too much until we iteratively develop high confidence that we know how to translate that investment into member value, like the increased retention we see when members play our games. So our investment by our scale is still relatively modest. It's a small fraction of our overall content budget. And as we continue to see incremental proof points, we'll ramp up that investment in a measured way. But we think this approach to sort of measured growth and planned scarcity actually yields a better business in the long term. And the long-term opportunity is large. It's about $140 billion in consumer spend, ex-China, ex-Russia, not including ad revenue. We believe in our top level strategic thesis, and we continue to learn into that executional capability to incrementally unlock that potential.
Thanks, Greg. I'm actually going to bring us back to a question on the results because we do have a late breaking question from Steve Cahall of Wells Fargo. Can you unpack the key drivers of the expected UCAN revenue growth reacceleration in Q2? Is it mainly pricing, or are there other aspects like advertising or subscriber growth? Maybe Spence, you want to take a stab at that one?
North America.
Yeah, sure.
growth,
So,
okay,
you
United
saw
States,
in
Canada.
our report, our UCAN revenue growth was 9% year over year in Q1. That was deceleration from about 15% year over year in Q4. The deceleration is, mostly due to pricing timing. So there's a little bit of a sequential quarter tough comparison because we also had the benefit of the NFL games and the advertising resulting from the NFL games in Q4, which also bumped it a bit. But think of it as we plan to reaccelerate again in Q2, and it's really getting the full quarter benefit year over year of pricing. And then also, ads is still a much smaller part of our business than subscription, but ads continues to kind of grow through the year.
Thanks, Spence. And I will now close this out with our last question, which comes from Alan Gould of Loop Capital. His question is, you've been guiding to $8 billion of free cash flow in 2025, and one of your goals is to deliver growing free cash flow. You have historically not spent a lot on acquisitions. Should we assume most of the growing free cash flow is redeployed into share buybacks?
Yeah, thanks, Alan. So there's no change to our capital allocation policy. It's been consistent for years now. We prioritize profitable growth by reinvesting in the business. We maintain ample liquidity. Those are key for us, our top two priorities. And then we return excess cash to shareholders through share repurchase beyond several $1 billion of minimum cash that we keep on the balance sheet, and then anything we use for select M&A. So that's kind of a long wind up to the answer is yes. In the absence of any meaningful M&A, not MBA, any meaningful M&A, we would expect that our growing free cash flow will be redeployed as share repurchase.
Excellent. Well, before we close, first, thank you all for joining us. I would like to take a moment to recognize and to thank Tim Haley for after more than 27 years on our board of directors. He is elected to not stand for re-election. For all of those 27 years, Tim Haley has been on this journey with us. His counsel and leadership has been a really valued part of our success. I'd like to say a special thank you to Tim for his long service and his many contributions to the Netflix board of directors. And let me say also, as someone who's benefited greatly from our time with Tim and has been there with him for most of those years, that through so much change and so much growth, Tim has always offered sage advice and counsel and is an important part of the history of Netflix. Tim has helped shape Netflix into the company that it is today. So many thanks to Tim. And thank you very much for joining us.
There we have it, folks. All righty. All right. We got to catch up on some super chats. And of course, we'll can't talk. And we will be discussing some of the things that were just talked about on the show. Let me get these first. We got these earlier from Butter Biscuit and everybody else out there. Let's see. Mexican Iron Man says for $5, why in the hellfire frack can I not get video live with Disney as a shareholder during their earnings calls? What in the absolute fricking hell? You get Bob Iger on a speakerphone. That's all you get. The premier movie production, television production, entertainment company in the world that you get Bob on a cell phone, speakerphone. The Mum for $5, Bob Iger. Oh my God. They're taking investor questions at Netflix. How dare they? Wait, should I take notes on how to do this? Oh, wait. It's time for my shower at my 4B building. Araxis gifted 5 Valiant Renegade channel memberships. Good to see you, Araxis. Mexican Iron Man came in question to Netflix CEOs. Can you guys buy my Disney stock on the stocks pop? They don't want that shit. Fire Disney and KK and take over the Disney Iger company before it turns into Kmart. Thanks, Mike, Mexican Iron Man Investments, which is not a real company. Butterbiscuit 92 for 5. What is this? Where are the AI questions, the BS deflections, and constantly telling us how they're a storytelling company? Sorry, Butterbiscuit, that's a Disney earnings call. You'll have to wait a couple more weeks for that pile of crap. Camchi for 2. NF, continue DEI and continue murdering beloved series. Netflix, continue. Well, I mean, there's going to be some of it, but let me tell you, here's the thing. Netflix has figured out a cost structure for doing this. They make a lot of different stuff. I mean, a lot of different stuff. Here's most of the stuff I watch on Netflix is a lot of the documentary stuff. I think that's some of their biggest shows. You know, the true crime stories and all that kind of, excuse me, all that kind of stuff. That's been real popular. And one of the things they're talking about on that earnings call was trying to continuously improve their algorithms that they use on there, their AI modeling that they use to try to suggest things to people that will keep them more engaged with Netflix. That's the goal of it, as well as advertising. They were talking about, continuously building their internal advertising system. Right now, they still use a lot of third-party stuff. They're still building their own internal systems for this, and they continuously want to move towards that so that they can have a system that will immediately place advertisers where they want to be with their exact target audience on the Netflix platform as quickly and as efficiently as possible. Nightwalker Medicine for 5, Netflix. We don't take anything for granted. Disney, flywheel, hungry versus hubris. To be fair, and you're right, but to be fair, Netflix during the earnings call did mention the flywheel word, but that flywheel at Netflix is very different than what Disney tries to refer to, with shuffling content and licensing from parks to films, films to parks to Disney Plus to merchandising to parks. And it's a lot of money that just circulates inside Disney. But like we talked about earlier, the key kicker here is, and I have to switch my screen, the key kicker here is to understand that what Netflix is, when you talk about the money coming into Netflix right now, the revenue that they are generating. Let's go back here. Okay. Here we go. When you talk about, how well Netflix has done for itself, Netflix is currently only down about, really not even about 5% from its high point just a couple of months ago. The rest of the big tech kind of stocks are still trying to claw their way out of some of the recent volatility from tariffs. Netflix is doing really, really well. Again, roughly 3 times the size of the Walt Disney Company now in terms of their market capitalization. And this $416 billion does not even include, of course, what happened after hours. So, I mean, when you look at that comparison, it gets even more crazy. Now, to go back to this was the report that Netflix put out. We started covering this before we went to the actual interview. We had the Q&A sessions there. Again, looking at the Q1 actual numbers, $10.5 billion. That's the largest quarter of revenue they've ever had. Every quarter is bigger than the last for the last several years. You look at their operating income is now a whopping 3.3 billion. The same quarter last year was 2.6 billion. That's a pretty significant jump. And you look at their margin, 31.7%. They're looking at a 33% margin for Q2. Again, last year's numbers were incredible. 28, 27, 29.6, 22.2 operating margins in the quarters. And again, this is just a streaming service. There's no theme parks. There's no merchandise. There's no $10 bucket of popcorn that costs 50 cents to provide. This is nothing but a streaming service. And look at what it's managed to do. And this is why people are high on the hog about Netflix's long-term prospects continuing to grow. When you compare this, and I want you to keep an eye pegged here. I want you to look at this net income figure. See that? 2.89 billion, right? You got your operating income up there. Then you got your net income. That's the net income they have before they pay taxes, right? $2.8 billion. They're looking at $3 billion next quarter. We're looking at about $12 billion maybe, or close to $12 billion of net income for the whole year if that trend holds. Now check this out. This is the end of year statement, the fourth fiscal quarter of the Walt Disney Company. I want you to pay attention to this. Income before taxes in the quarter, Q4, which would have ended September 30th of last year, because Disney's fiscal year runs from October 1st to September 30th. So we're going fiscal year to fiscal year. I know the calendar is different, but we can adjust for that when Disney puts out their new numbers here in just a couple of weeks. But I want you to look at the fiscal year, $7.6 billion. $7.6 billion was what they did in income before taxes, net income, right? Before, $7.6 billion for the whole year. The whole year. Netflix is already on pace to smoke that this year. So Disney's going to have to, really start playing catch up here. And again, why do we keep comparing Netflix and Disney? Well, they're the two biggest monsters, arguably, in the entertainment space, just in terms of sheer scale and size. But again, Disney has so many more facets to it than just the streaming. Obviously, streaming is the weakest piece of the pie for Disney. It's the nothing burger for Disney. Netflix has figured it out. Disney still hasn't. And if anybody is under the delusion that in any time soon that Disney is, between even Disney Plus and Hulu, and even, throw in ESPN in there, which hasn't happened yet. They have ESPN Plus, a different animal. But just take the combination of Disney Plus and Hulu, which is roughly the equivalent of what a Netflix is. They're still nowhere close. And they're not going to be generating $10 to $12 billion a year in profit probably anytime soon. The growth isn't there for Disney. People don't sit around on Disney Plus to see what's on. The advertising revenue for Disney Plus is probably never going to be anywhere near as good as Netflix, because the type of audience that you need to drive that sort of revenue isn't there. We talked about stories several months ago. Disney was having a lot of problems. First of all, selling ads on Disney Plus because the viewership was terrible, except for a few limited, young children's shows, which is not necessarily the kind of advertising demographic that most advertisers are looking for. But they weren't even holding on to advertisers with big headline Marvel shows and big headline Star Wars shows, because the viewership just wasn't there, like we've been talking about. So again, when you compare these two things, nothing could be more stark. Income before taxes declined Q4 from $1 billion and increased 59% for the year, to $7.6 billion. So $7.6 billion in net income. And again, what are we talking about over here at Netflix? Well, we're talking about, for the year, net income, if you look at it last year, here we go, was about $8 billion. Close to 8, right at 8. And this year it might be, north of 10. Operating income probably over 12. So Netflix is winning right now. They're winning the money war. Let's put it that way. I didn't think, think about this. You think about Netflix just 10 years ago. Nobody imagined that this would ever be possible, that Netflix one day would, in the entertainment space, be the larger juggernaut. It would have absolutely crushed Disney, but we're basically there now. And I think this year is going to put a pin in it. And you hear Netflix on this earnings call talking about how animation, right? They said 9 of the 10 biggest things in the last year is in terms of consumption, in terms of hours watched, minutes watched, were animated features. That's where Disney was winning, of course, right? You think about things like Moana, and things that land on Disney Plus like that, where kids just watch it over and over and over. We've seen Netflix expand. What did Netflix just do? What was announced just in the last month or two was that Netflix expanded their contract with Universal, right? It used to be that Netflix just got the animation features from Universal, which has been a big boon for them. And then the live action stuff would go over to Amazon Prime. They took the live action stuff from Amazon Prime. It's now all going to go to Netflix, I think, starting either this year or maybe next year, is when that's going to go down. So Netflix is really making a play. In other words, right now, the bulk of Netflix's audience are still adults watching adult content, right? Not when I say adult content, I'm not talking about porn, right? Just talking about adult. We're not talking about cartoon shows for kids. We're not talking about children's programming. They're really trying to expand those animated type features. If they can get more stuff from Universal and Sony, like they made their How to Train Your Dragon TV show on Netflix. They've made the Jurassic Park TV show for Netflix, right? And that's all from places like Universal, who owns Illumination and DreamWorks Studios that make all of that, including Super Mario Brothers and everything else. So that's the kind of stuff that they're after, expanding. And that's kind of where we're at. Now, one of the other things I want to show in here, they mentioned, here it is. They talked about how, YouTube is the biggest thing in the US. Well, guess what? Not so in the UK. And this is what they were kind of talking about during this call. Television share in the United Kingdom, in Great Britain, right? Netflix is bigger than YouTube. Netflix is the largest single entity, consuming 9%. Okay, YouTube at 7% in the UK, so almost 30% bigger audience or more consumption on Netflix than YouTube in the UK. Disney Plus at 2.9%. Now, notice that's not Disney Plus and Hulu. It just says Disney Plus. I don't know if they really have Hulu in the UK or if that's through one of their partner Sky or something. I don't remember. Prime Video 2.8. So Amazon Prime and Disney basically neck and neck. Other streaming / video sharing services, 11.3%. Unidentified, and they say that unidentified includes game and video content that cannot be audio matched, meaning using artificial intelligence audio matching, so they know what you're watching. 50% of the consumption in the UK is still linear. Think BBC, right? Think Sky, all that other kind of stuff. Linear broadcast, cable TV, over the air. So it's a very different dynamic here than in the US. But it's striking to me that Netflix is absolutely dominant over there, and beating YouTube. So again, when Netflix talks about expanding, and they have a lot of runway, that we have a lot of places to grow. This is clearly what they're talking about, because outside of the U.S. are very, very different markets, and there's a lot of market share even still in the U.S. for them to chew up. They're very bullish about this, and they seem to be doing all the right things in order to get there. And you listen to how they sound on an earnings call. They sound excited about what they're doing. They know they've got more stuff coming. Each and every time almost for the last year or two, they've been surprising Wall Street with better than expected returns. Everything is coming up roses. The horizon is always brighter, kind of thing. You listen to a Disney earnings call these days, and those very same people that called in or that sent questions in today, the guys from MoffettNathanson, guys like Ben Swinburne from Morgan Stanley, the questions they have for Netflix, hey, give us clarity on this, that, and the other thing. You listen to some of the questions they ask places like Disney now, it's more concern. Are you concerned about what's going to happen in the parks? What is this moderated demand for this? How much longer before we see some serious profit margins from streaming? And remember, Disney decides to conceal Disney Plus behind Hulu, right? They don't report, this is how much money Disney Plus made, and this is how much money Hulu made. They put Disney Plus and Hulu together and say, oh, magically we started making profits. And that's largely because what everybody seems to believe is the fact that Hulu is probably fairly successful and does make a positive return, but Disney Plus is probably almost certainly still losing money at this point. So if they were to break those two things out, we'd have a very, very different story here. But it's a tale of two streamers, and Netflix is clearly king. And there's some other obvious other streamers out there, Paramount Plus, Peacock, some of these other guys, but they have a very different model, right? They're streaming services that are self-contained to their own proprietary studio. Universal, Peacock, Paramount Plus, right? Netflix is a consumer of everything. Hey, if we can license your content, we think it's going to be of value to our members, we'll write a check, right? That's the big difference. You're never going to see content, I don't think, from Warner Brothers over on Paramount Plus, unless they have a special sharing agreement for some particular project. I don't think that you're going to, you're probably never going to see Disney content licensed out anytime soon, because I don't know why they haven't done it yet. Something's been sitting on Disney Plus collecting dust for years. Why not license it out to somebody else like a Netflix or an Apple TV? Disney is very stuck in their old ways. And the difference is Netflix is very fluid. They will adapt, they will adjust, they will change things. And Netflix obviously has a pricing model that's working very, very, very well for them. So just want to throw that out there. Okay. Let me go back and grab some more of these super chats here as we wind it down. Let's see, where were we? We've got Butter Biscuit. We got that one already. Sorry. We got that one, and Nightwalker, we got that one. Oops, here we go. Mexican Iron Man for $10 for the record. Valiant called this out 2 to 3 years ago, whereby Disney brings more revenues in, but Netflix smokes Disney's actual net profit. The winning formula: less showers, more profits. Reference to Bob Iger there. Yeah, I mean, when you look at the Walt Disney Company that brings in last year almost $99 billion in total revenues, and their net income from all of those operations was about $7.6 billion, and their operating income was about $12 billion. When you look at Netflix bringing in $39 billion, right? So less than half, 40% basically, 45% of Netflix's total revenue. They're bringing in less than half of Disney's revenue at Netflix, and yet they're now on pace to turn in even a good bit more dollar profit than the Walt Disney Company will, with all of its advantages, with its big Disney brand name. Not saying that Netflix doesn't, but Netflix isn't so much a brand. It's the content they have in there. I mean, it is a brand, but when you think of Disney, you imagine Disney as a very long-term brand. They don't have the parks, they don't have the merchandise, they don't have the intellectual properties, and yet they are stomping Disney bad. Hawaii Dragon Star for 5. Universal is hitting Disney in the parks. Yes, they are. Netflix is hitting Disney in the streaming and entertainment. Yep. Only their cruise ships and ESPN sports are left. Yeah, I mean, look, the parks aren't going away. Their streaming services aren't going away. But one of the things that I think, as we wrap this up, that I would say, I think Disney's model is very unique. Disney believes that they can compete with Netflix, and they're spending money trying to make content for Disney Plus and streaming as if they were Netflix. They're not. The audience isn't there. They're over on Netflix, by and large. Other studios out there, Peacock, right? Peacock's still in the hole, but they're a teeny tiny little streamer by comparison. They don't have the scale yet, right? They don't have near the scale of a Disney or a Netflix or anything like that. Max, HBO Max, again, also a very, very different model. It's a hybrid model because it's still inexorably linked to linear broadcast HBO, which has been around for 40 years or more. That's a different model altogether. In fact, Warner Brothers HBO Max is probably the most unique model that there is in the industry. But in terms of being a pure streamer, right? Disney Plus, it's got some shows on there, but Disney's winding out some of their linear. The stuff that's on Disney Plus that's really driving Disney Plus, first of all, is not even Disney content. It's things like Bluey that they license in. And then they're big IPs, and that's the difference. You don't see Universal or Max, even HBO Max, or even Paramount by and large, where every major new show they're putting on there is costing $200 to $300 million. I mean, it's absurd. Yes, they'll have some big ones in there, right? Maybe 1 or 2 a year. The difference is that they're turning the audiences out. Look at the audience right now for every Taylor Sheridan show. They've got in North America alone, they have 15 to 20 million people tuning in every single week or more to watch those episodes of 1923. We saw it with Landman. Now we're about to. It's starting to ramp up now for Mobland. Okay, which is an amazing show on Paramount Plus. Their audiences justify what they're spending to put out there, and even they are trying to cut back on some of these budgets from what we hear. But it's working for them because they're always in that. They're either the biggest show every week on Paramount Plus or the second or third biggest show every week on Paramount Plus, especially when you adjust for episodic release versus Netflix dumping things like a binge model, right? Disney dumps things out on episodic release. Couldn't get the last major Star Wars show to chart even one single week. Skeleton Crew. And the threshold wasn't that high. Even if they had gotten, even if Skeleton Crew had managed to pull, I think I have to go back and do the math again because I don't recall exactly what it was. But I want to say we figured that even if they had gotten just about 4 million people watching it in North America, it should have shown up in the top 10. I don't think it was there. It was so bad. Disney, if you remember, I don't even think Disney ever released data on Skeleton Crew in terms of viewership. That's how bad it was. That was probably not a cheap show. And now Disney Plus has Andor Season 2 coming. And I mentioned this, I think, on last night's show. If Andor Season 2, and they're really trying to gig those numbers, they're putting out 3 episodes at a time, probably around 2 hours of content, I would say, at least between 3 episodes. They're trying to run up those charts. If Andor can't get into like even the top 5 on Illuminate chart with 2 hours of content, basically doubling up on all of its competition. So it's already got an ungodly advantage. All right. The final episode, let me put it this way. The final episode of 1923 season 2 happened about a week ago. Nearly 3 billion minutes watched that were clocked by Illuminate. 3 billion from Sunday, Monday, Tuesday, Wednesday, and Thursday. Okay, because that's how Illuminate charts. It had about 4 or 5 days in there. 3 billion minutes watched, and that was, I believe, about a 1 hour and 45 minute, roughly, final episode. That's a lot of people watching that show. It's about 20 million, okay? 20 million people tuned in for that week, right? And if it acts like some of these other shows on Paramount Plus, where Landman was still charting in the top 10 6 weeks after the final episode of season 1, which is insane. This is what Disney needs a hit like this with Andor, desperately to justify the over $600 million the Walt Disney Company spent on 2 seasons of this show that we know of so far. And all the filings have not come in yet. So that's the kind of thing. We don't see Netflix dropping $300 to $500 million consistently on massive endeavors. Yes. Oh my God, they spent $300 million to make The Electric State, which, look, I thought it was a charming, fun little movie. It wasn't great. I thought it got overhated. $300 million, but that was a turnkey operation, right? Because that's not a Netflix property project. That was we're going to give you $300 million to make this film, but we own it in perpetuity. We're not paying you any residuals after this. It's not going to theaters. It's a turn. So the movie itself probably cost 150 to 200 million to make. You know, it's probably somewhere in that vicinity. And then they got $100 million of profit on top. That's how Apple TV is doing it with these Martin Scorsese films, the Ridley Scott films, like we talked about with Napoleon, Killers of the Flower Moon. You know, those films didn't cost $200 million, but that's what it says the budget for those films was, because Apple wrote a check to those 2 guys, Scorsese and Scott, to make their 2 movies. But it was, we own it. You're going to make a turnkey product, but we, Apple, will own it. You have no rights to it after this. So, yeah, it might only cost $100 million to make the film, but we're going to give you $200 million for your profit to keep. after it is ours. So a little bit different model. Disney, on the other hand, Disney makes Star Wars. Disney owns Star Wars. They don't have to pay overhead to anybody else. They own Star Wars. They own Marvel. They're spending just for production. They're spending $200, $300 plus million for a season of these shows. Doc Hollywood is here for $50. I know this is way off topic, but what pistol would you recommend for concealed carry home defense? I like my 6 Hour P365. Very reliable. Great, simple 9mm pistol, a P365, and they make it in a compact that's really easy to carry. They have a full-size version that is, it's the full-size version to me are a little bit easier to shoot because they're a little bit more front heavy, so you don't have as much recoil or muzzle climb or stuff like that. But those are great, very easy to get. Everybody sells them pistols. I really like those. But I've also got Smith & Wesson M&P shields that are great. There's Anik actually really makes some nice pistols. It just, the biggest thing to me is like, I don't know how big your hands are. I don't know what your shooting style is. I don't know, how much you're going to conceal versus keep it home. So I would go to I would say go to Academy or something like this. Go to a good local FFL, a firearms dealer in your area, and try a few things out. And sometimes it's as simple as just putting it in your hand, because that's the biggest thing, is to physically put it in your hand and see how it feels. Okay? Because that's what works for me might not work for you. What works for you might not work for me. It just depends on your own personal preference. But I would look at the 365s because they make several different models and sizes. They got the full size, you got a 4-inch barrel, you got a compact, but they're $500, $600, $400, $500, $600, depending on which one you get. They're not super expensive, and they're really, really good. Thank you, Doc Hollywood. Appreciate it. Okay. So I think that gets us caught up for that one. We will be back on Sunday. Hope everybody has a happy Easter there. Oh, we got Crimson Splat for 2. Nothing to say, so I'm saying it. And for Doc Hollywood, we got a treat for you with that $50 super chat. We got to play this one again.
That's a good question. What happens is the center has the ball first, and quarterback will say hike. That's when the center puts the ball into the hands of the quarterback. So what I'll do is I'll start tackling the quarterback unless he give the ball to somebody else, in which case I'll try to tackle that person.
Oh, man. I love that one. Superfly, 17-month member, says, sorry for the dumb question. There's no dumb questions here. Would a VPN affect the regional numbers, like a Brit using a VPN to say they're in Korea? That's not a dumb question. It's actually a good one. Here's the thing, though. And I don't know the answer to this, but I suspect the answer is probably not many. How many people, especially in terms of overall percentage, number one, actually use a VPN? And then number two, use it to mask their location to hop, right? Some people do. But I'd be surprised if it's more than 1 or 2% of every Netflix user. I'd be really surprised if it's 1 or 2%. So it's possible. But then again, let's say you're a British subscriber, a member of Netflix. Well, they know you're Brit, right? You sign up, you put in your billing information. This is your account. The other thing, though, too, is because you have to log in with your account, a lot of times, like if you're using a VPN, Netflix recognizes it. Maybe not right away, but they will recognize it eventually, like within a few minutes. And then the screen's going to blank out and go, oh, it looks like you're using a VPN. We don't like this. And then it makes you reset or turn the VPN off. A lot of websites, especially streamers out there, are doing that now. So just bear that in mind. I don't know how effective VPNs are really going to be for these kind of things, long term. So, yeah. Thank you for the member chat. And I'm getting more stuttering today on my screen from StreamYard. I don't know if you guys are seeing it or not. Last night you told me that you weren't. So we'll just roll with that. But like right now, it's really laggy and stuttering, and it's frame skipping like crazy. So any case, I don't know why. Don't know why. All right, guys, thanks for hanging out. Appreciate you. Still about 340 of you watching over there on YouTube. We had another 300 plus watching on X. So welcome aboard. Just hit that like button for me before you head out. Appreciate it. See, look, Big Blue Horses. He's got a 365. See, everybody I know loves those things. I think they're one of the most popular selling pistols in the country, and for good reason. They're really, really well made. Oh, but SIG had all the recalls because they used to go off on that was one specific model, and it wasn't the 365. 365 has never had issues. That was the P320. I've never shot a P320. I've never owned a P320. So when I heard all this stuff about SIG, I was like, the freaking hell are y'all talking about? This sounds bizarre to me. So I don't know the whole details. So apparently there was one little quirk in that. I think they've fixed it since then because they still sell the P320s like crazy. So I think it was a certain line of 320s, maybe from a few years ago, or certain serial numbers. I don't know the whole story. I don't know. But like I said, I've got the 365 and couldn't be happier. I've got a P229 as well, which I really love. It's got the exposed hammer in the back. You can. It's a totally different style of weapon. It's the one that the Navy SEALs and Navy pilots used to use years ago. Really, really excellent firearm. Those are more expensive than a 365 though, and a 229 it's a full size 9mm. It's not something that I would necessarily consider a concealed carry weapon. So anyway, I'm lagging a lot. I'm glad you guys aren't seeing it because this is driving me nuts. My screen is absolutely crap right now. So no dumb question. All right, guys, let me get on out of here. Hope you all have a very, very wonderful and happy Easter weekend. I'll be seeing you Sunday. Like I said, we may be starting a little bit later. Stay tuned for that. I probably won't know until Sunday exactly what time. So be patient with me that afternoon, but we will have some sort of show lined up. So hang in there for me and see you then. Take care. Make sure to catch the clips of all these videos coming up on the channel tomorrow.